Namaste viewers. Mahindra Mutual Fund is owned by Mahindra 51% and Manulife Investment Management Singapore 49%. Manulife is a Canadian company. Manulife manages over $1 trillion of assets worldwide. In India, Mahindra is known to everyone. They are a large industrial house. Mahindra Mutual Fund manages about 10,000 crores of assets right now, out of which 7,000 crores forms part of equity. Mr. Krishna Sanghavi oversees this equity part of the assets as Chief Investment Officer Equities. He is a CMA from Institute of Cost and Works Accountants of India, over 24 years of experience in the asset management industry. Prior to joining Mahindra Mutual Fund, he has worked with the Canara Robeco Mutual Fund, Kotak Mutual Fund, and Aviva Life Insurance. He brings with him a vast experience in fund management. Today we have Mr. Krishna Sanghavi, CIO of Mahindra Mutual Fund with us. Talk with him, discuss with him, and pick his brain to know more about Mahindra Mutual Fund, its operations, its framework, fund management framework, and what they expect about the market, how it will behave, and so on. Welcome, Mr. Krishna Sanghavi. Glad meeting you through Zoom.
Hi.
And most of our subscribers, they would like to know what is happening in a mutual fund, why certain fund house is performing well, what is the process behind it, all those things. So along those lines, in the past few years, if I see Mahindra Mutual Fund, many of your equity schemes have been doing well. I would say outperforming the benchmark, etc. And it is across multi-cap, large and mid-cap. Many of your funds are doing well. So what is the reason behind it? Is one of the reason because of your joint venture with Manulife?
No, thanks, and thanks for saying our schemes are doing good. And yes, we've had a good fund performance for quite a few of our schemes especially last couple of years or so. If you look at the organization, we are around 6 years old in terms of overall Mahindra Mutual Fund, what it was earlier, and now it's a Mahindra Manulife Mutual Fund since last 2.5 years kind of time frame. I think what broadly helped is clear some sort of input coming from Manulife as a global organization. They operate in terms of investment is spread all over the world, nearly a $1 trillion kind of assets across all asset classes, including equity, debt, real estate, and maybe something like farmland, etc. I think that global input clearly helps. At the same time, whatever we do here locally in terms of the team strength, the combined knowledge and experience of the team, the capability on research and fund management, also does its own share of contributing to portfolio performance in line with what ideally one should be doing. And let's not forget, last 2 years odd has been very interesting period for the market. We've just been stabilizing from the COVID related lockdowns and COVID related slowdown. So to an extent, yes, I think some focus on overall portfolio construction process, along with some reasonable clarity about what perhaps it looks an avoidable ideas at the current juncture in terms of either the corporate governance standards of a company, which honestly corporate governance is slightly far more a longer term phenomenon, but the balance sheet or the current business outlook is driven by the demand supply for the products, the pricing power, the cost structure, etc. I think those focuses have clearly helped us in our portfolio construct and outperformance.
Very good, very good. Glad to hear that. And if you can, in simple terms, if you can explain to our investors your fund management framework and philosophy, because every fund house, they go with some philosophy in their mind or some framework in their mind in the way they choose the stocks and the way they construct the portfolio. So in a layman's language, if you can share with our subscribers your Mahindra mutual funds, framework, investment framework and philosophy would be great.
Investment process I'll share, but I'll share you the bigger picture on equity as an investment as a class. Equity as an investment class is nothing but appreciating growth over time, which results in wealth creation. And if you look at growth in the market, or in the economy rather, the growth comes in two shapes. One is the real growth, which is in terms of physical growth. The other is the financial growth or the nominal growth. So, for example, we are used to a number, the real GDP is, let's say, 7%, and the nominal GDP is 13% or 15% kind of number. So, nominal GDP adjusts for the rupee value of change over and above the physical volume of growth. So, using this example of real growth, nominal growth, the next variable relevant to market really is the quality of management which is running the businesses. If you look at it, every company has their own set of ownership and management as a primary people who operate business for us as an external shareholders. So one variable relevant there is management. So using this broad framework, I think let me come to what investment framework we at Mahindra Manulife are using. So we use a framework called growth, cash flow, management, and valuation. We call it GCMV, growth, cash flow, management, valuation. What does growth really mean? As I said, the growth typically means the real growth as well as the nominal growth, because for every company to grow, it may grow by pricing power. It may sell 10% more units, but at 7% more price per unit. So which effectively means around 17-18% kind of revenue growth is possible. A combination of physical volume as well as the financial pricing. So one is that growth. Other growth can come by way of some sort of cost reduction, in the sense that there is a growth in profit finally matters far more than growth in revenues. So if you're able to sell more products at possibly higher price and or have a lower cost for selling those products, you will have a growth in your profitability. So that growth in profits is perhaps one variable. Second is, we are also interested in observing, is this profit in hand, or is it only always in the books as data or as a inventory? So which means the cash flow matters. If a company makes, let's say, 100 crores of profits, but 100 crore results only into 60-70 crores of cash flow, vis-a-vis a company which makes 100 crore profit and generates exactly 100 or maybe slightly more in cash flow, we will obviously prefer a company which is generating more cash flow for the same profit. Because the reason is simple. Cash flow is in a way a very good indicator of the real health of the business. So the another advantage of cash flow really is that the same cash can be used by the company to generate future growth by way of setting more capacity, creating more asset base, or buying more raw material for conversion. So that's the nature of cash flow, which matters and which supports the growth. Third is the management quality. As I was mentioning, almost every company has their own set of principal managers and owners. We generally rely on them to make good decisions for us on a daily basis in terms of both the ethical side of it, which is the integrity, as well as the execution, which is the outcome. So as long as there's a right set of management, and how do we define right set of management? Perhaps one example really is comes from the past experiences which they have, either directly having experience or maybe using enough past information available through various routes to figure out or to understand what was this particular management doing maybe 5 or 10 years ago. Is it something which is not only reliable from integrity, but even reliable from a ability to execute? You'll always find many people where the integrity wise, no doubt, but they may not have been able to prove an execution or a scale up. So that's a third variable called management. So as I said, growth, cash flow, management, and the fourth variable, which is actually the toughest, or really where a differentiated approach does play out, is really valuation. What I mean by valuation really is that what the stock is trading at, maybe the current year earning or the earning 1 or 2 year down the line. But that adjustment, after that, we also make adjustment for the visibility of the growth. Can this company sustain a slightly higher growth rate for a longer period of time? Then obviously, one is willing to pay slightly more price for it. Or is this, growth visibility a bit short? In that case, one would not like to pay far more amount. I think that's the way we look at all the four variables: GCMV, growth, cash flow, management, valuation. So having seen this entire picture, one can actually arrive at our own estimate of what is the likely fair price based on our understanding of valuation. So then you compare your actual stock price today versus our own, framework, which gives some sort of a range estimate for what this fair price can be or should be in our estimate. And that there is typically always a gap. And then the idea is to figure out, is there a roadmap? Is there a some sort of an opportunity for that gap to be closed? So once you are able to spot some opportunity for growth, for that gap to be narrowed, we believe this valuation gap between our own framework versus the actual price, that gap can be bridged, through some event, and that event is what possibly helps us trying to time the particular purchase. Having identified the same company, found it investable, one tries to time it in terms of managing the right entry points in terms of stock price or the events. So that's a broad philosophy, broad thought process on the investment framework which we use at Mahindra Manulife.
Okay, okay, I understand the GCMV framework that has been more successful for you, so far, and hopefully you will be fine tuning that, as you go, as you
So
progress.
clearly, yes. So I
Yeah.
think all these frameworks are honestly a function of our experience and our experimentation with new data. Because as markets have taught us, you always find new variables which change, and moment some variables change, we are required to update our own understanding. So as you said clearly, yes, this model keeps on being refined with new inputs and new data points.
Yeah, good. One more thing is, in the past couple of months, if you see, the markets have zoomed, like, I don't know, maybe 10%, 12%, whatever it is.
Yes.
Everyone was expecting it will go down further, further, further. So what is the reason behind for the sudden exuberance in the market?
No, I think one answer you only gave, that everyone was expecting markets to go down and down. So typically, sometimes this happens. Sometimes this happens where the expectations are, perhaps becoming one-sided. And let's not forget, exactly 1 year back or 9 months back, there was a reverse expectation. Market will keep on going up one way. When we were at 18,600, let's say in October or November 2021, there was exactly the same expectation that we will keep on going up one way. Maybe somewhere, I think that the reality is that yes, there are those extreme, moments in markets where a lot of people end up converging on same side of thought process, and that's where market gives us a surprise. Now, in this particular case, why the surprise come is slightly tough, because one cannot really rationalize and every event giving a perfect logical outcome for the what it has happened. But I think broadly what has happened in last 6 weeks or so period is that I think markets on an average globally, not only India. First of all, let's be honest to admit that it is not only Indian markets which have moved up. Almost all markets in the world has moved up, including US also. Quite a few US indices are up more than 10%. Similar to, let's say, Indian markets being up 12, 13, 14%, depending on the index which we choose. I think what's changed in the world is only one thing, which is the expectations have suddenly come in that US Fed might just do a rethink on their own thought process of tightening the monetary policy. And the reason is the data point being bad. It's a bit of a circular world. When the economic data point turns bad, some set of people in the market ended up believing that because the data is bad, a US Fed will perhaps stop its behavior of tightening the monetary policy for a longer period of time. So I think that's the primary reason. Otherwise, yes, you'll definitely find a lot of company specific or sector specific reasons for why a particular sector has moved up and down. But I think the macro reason is honestly the expectation that if there is a recession in US, US Fed's objective of cutting the economic growth is met much earlier than what one would have expected, and by default, more tightening need not happen. So that's, I think, in a way, the likely reason for why markets actually moved up very sharply in last 6 weeks.
Okay, okay, okay. Very well said. And from now on, say like, is the market is weak, or probably what is your expectation? As you told, you identify the companies GC under GCME framework, and then wait for stocks to come to your price point to buy. So is it the right time, or how is the market looking forward? From here on, in the next 3 months, next 6 months, in the short term, will there be still volatility, or there is possibility to come down to go up? What is your thought process as a fund house?
No, I think if we look at the equity market journey of last 3, 5, 7, 10, 15 years, we learned one thing very hard way. More shorter term focus you are, more likely to get it wrong, because ability to predict not only the economic growth but even the market reaction to the growth in a short period is very tough. On the other hand, the ability to anticipate a growth over a longer period of time clearly is useful. And I'll just give one small data point, which is what honestly is all about the growth and growth characteristics of India as a country. In 2006, if I go to December '06 broadly, Nifty was 4,000 levels. Today, Nifty is 17,000 levels, 17,500 maybe today. In December '06, Indian GDP at market price or the nominal GDP was nearly $1 trillion. This is broadly the World Bank estimates. $950 billion was a broad number. And India was 14th ranked country in the world in terms of GDP. Now come to 2021, which is December 21, exactly 15 years from that original 14th rank and slightly below $1 trillion economy. We are around $3 trillion economy, again slightly below somewhere at $2.9 trillion economy. We are 7th rank in the world. And as I mentioned earlier, the Nifty has moved from 4,000 to 17,500. So there is an economic growth as represented by nearly tripling of economy size. And this is dollar, so let's not forget the rupee dollar impact. So in all fairness, I think the economic growth has reflected into Nifty index rising, market cap creation, wealth creation for Indian markets. And that's the beauty. If I just extrapolate this to forward range on economy itself, I think economy, which is right now number 7, is expected to be somewhere in number 3 rank in next 5 to 7 years, before end of this decade. So imagine a situation where something which is $3 trillion can become $5 trillion plus in next 7 years or 5 years, and that's the entire journey of market. So my suggestion to all the investors is, please do not worry about next 3 months. Yes, you worry about next 3 months more for knowledge, more for anxiety, but do not worry about it for investing. When you are investing money, your focus should be for next 3 or 5 or 7 years, depending on your own personal aspirations and personal risk profile. Uh, Anticipating 3 months should be more of a fun rather than investments, and that fun need not have money being involved. It can actually be done more as an intellectual level rather than putting money only for 3 months.
True. Now, the main thing is people who have been waiting in the sidelines after seeing, oh, it has gone up by 10%. Is it right time to enter, or should I wait? So that is.
I'll put it this way. There are basically two kinds of investors. One investor who is actually investing for the long term, and that long term is defined by 3, 5, 7 years kind of time frame. For those investors, very conceptually, SIP has been found to be the best route for investing, because you are able to take advantage of ups and downs. You spread the same investment over a longer period in terms of 6 months, 12 months, 18 months, depending on your time frame. Now, if you really have a 3-year time frame, my suggestion is, finish your SIP within 18 months itself. Let the money be given some time to work. But if you actually have a 7 and 10-year investment time frame, then you can actually afford to have even a 3 and 4 year SIPs. Because after you complete your last SIP, your money needs some time to compound, right? I think that variable one can add. So for those people where investment horizon is a bit longer, just simply do not worry. Just focus say, okay, I have a simple route to wealth creation, which is systematic investment plans. Markets will keep on doing up and down at various points of time. and I will use those opportunities to buy. So that is one kind of investor. Second kind of investor is really somebody who is, more interested in a lump sum investment with a limited time frame rather than a long-term time frame. I think for that set of people, yes, they can worry about a lot of these variables of market behavior, etc. But there also, studies have shown that even in that period, as long as your time frame is reasonable and not really a 3 and 6 month, there are fair probabilities or fair chances of actually making money.
True. I do agree. Now, these 5 or 10%, whatever ups or downs in the market won't affect you in the longer horizon. When you invest for 7 years or 10 years or whatever it is, generally
Yes.
whatever your investment horizon is. One of the things, as you earlier pointed out in your discussion regarding the Fed rate, and they are raising the rate because of the inflation, going up in USA as well as Europe, unheard of. Even in India, we do not have that much of inflation, 9%, 10%, 11%, whatever it is. And some of the, other countries like Turkey or Zimbabwe, they have inflation like 70%, 80%. So there is two extremes, and comparatively, India seems to be in a good spot. But what will be the effect on Indian economy? These inflations in US, on one side, inflation is going up. At the same time, dollar is strengthening in US. All those things. These are all complicated things. But the thing is to put it in a simple way. What will be the effect on Indian economy? The inflation in the developed countries.
So I think so this also has to be seen slightly in a different context. So let me put it this way: if inflation is, let's say, 7% or 8%, but if the real GDP growth rate is 7%, then we are talking about 7% real, maybe 8% inflation. So that makes it a 15% nominal. Against this, let's look at some Western developed worlds where the real GDP will be below 3%, but the inflation will be 8-9%. Suddenly, the mix is very different. In the first case, if there is a 15% kind of nominal GDP, we are discussing 1:1 ratio between real and inflation. In the other example, we are broadly discussing 1:3 ratio, in the sense for every 3% real, if the nominal is going to be 12, you really have a different set of challenges in those worlds. So I think what I will say with inflation is inflation has three variables. Number one, it actually hurts a little bit on the economy side, because when the central banks of the country decide to tighten the policy, they really want to reduce the growth, or they want to somewhere impact the growth. So that is one variable of inflation. That's where all this discussion of what US Fed does or you will do and what RBI will do, etc., resurface during high inflation. Second part of inflation really is that corporate uh, companies really enjoy inflation in a way, because they get ability to make more money for the same output, which is the beauty of equity as an asset class. In a higher inflation, typically equity ends up benefiting in terms of stock, companies earning more profit rather than less, because they are able to make, yes, you will have to find some winners and some losers of inflation. So for example, for every sector which benefits from inflation, they might be selling their products to some other segment, and that industry might suffer because one man's expense becomes other man's income. So that's the second variable, which is corporate profitability typically goes up during inflation. And the third variable is valuation. Now, valuation is a little bit tricky part, because valuation is derived by interest rate being the underlying variable. And so when typically there is a monetary tightening by central banks, RBI or Fed, you have a challenge where while earnings can grow, the valuation multiples can come off. So these three, variables which we look at in arriving at, let's say, what is the likely implication of inflation on the markets. So coming to, yes, what US Fed has been doing, they had an amazing period of quantitative easing over last maybe 30 months or so, right from March 2020. They've done amazing amount of monetary investing or monetary financing the economy. I think they are right now talking about taking some money back. They're talking about raising interest rate in the same period. So we'll have to watch out for those implications, because for them the priority is suddenly that 9% inflation typically is much higher than what they would have ever imagined in last 10 years. If you look at last 10 years or so, their commentary was that we want inflation at around 2%, 2.5% range. Suddenly they've got 8, 9%, and that's where, I think they are slightly busy, raising rates much faster. So in a way, what's playing out in the market is, while corporate profitability might be slightly better, again, depending on which sector and which segment, the challenge lies, in valuation multiples, because interest rates are actually going up as a part of the tightening process.
Okay, understand. So, does this have any linkage with Indian markets performing better than US markets going forward?
No, clearly, yes, because even if there is no inflation, I think concept level, Indian economy is on a fast track. And, the same example I'll possibly reiterate, the cost of reiterating. We are seventh largest economy. We are likely to be number 3 in next 4, 5 years, which actually means by nature that we will grow much faster than everybody else. That's the only time you gain ranks, by growing much faster. So I think yes, Indian economy will do well, and we do expect the Indian markets to outperform, in a way, those global uh, equity markets. At the same time, yes, you'll always find some stock, some sector in the global market which can do well better than India, but that's not the entire story. The story is, as a country, as an economy, we will do well. And I think ideally we should stay invested, in the Indian assets. And yeah, there might be some opportunity of some other unique stocks or unique sectors, but I think bulk of the money maybe should lie in India.
Okay, good. That is great news for Indian investors. Anyway, that's the thing. And coming from the economy side to the individual side, in the sense from a Mahindra mutual fund perspective, why should investors look at Mahindra mutual fund, for investing? There are 30, 40 companies today now. What you bring to the table as a fund house, why should investors look at?
No, I think at Mahindra Manulife Mutual Fund, we clearly focused on, delivering customer expectations on both uh, the business side in terms of investing, wealth creation, which in a way can be said as fund performance. But beyond a point, wealth creation, I think, is bigger priority. And second part, is the customer service, the sales experience, etc. I think those two we are clearly focused and committed. Coming from, Mahindra Group as one of the sponsors, owning 51% through Mahindra and Mahindra Financial Service, and Manulife owning 49%. Manulife is a global entity. So between the two sponsors or two promoters, we cover a good understanding of both Indian economy, mainly through rural India, as what Mahindra Group's expertise is, and maybe, the urban wealth creation offered by Manulife as a globe. I think we do understand, perhaps, how I think the markets, the economy are functioning, and our endeavor really is that use our combined knowledge of not only the promoters but even the management team, fund management team, to deliver that fund performance, which is, going to create that customer delight. That's a broad message. Yes, we are in a way relatively younger organization, and that somewhere adds value, because we've learned over time in last 10, 20 years that typically challenges have a far better opportunity of success, because they're willing to experiment in terms of new knowledge, new information comes, and be able to act on it.
Good. Mahindra, as such, as you really said, Mahindra has a very good brand image all over, and they are one of the good corporate governance houses. That's a great thing. And
Yeah.
moving to the sectors, some of the sectors which might do well in the Indian economy going forward, because in the past, like a steel sector was doing good and some other sectors were doing good. What is your expectation going forward? Which sectors, which segment will do good, or where you are putting your money more?
No, I think again the sector thing, I will answer two different way. One is, as a macro picture, if you are really focused on India doing well over next, 3, 5, 7 years journey, I think all sectors will do well. It will be a time between sector A and B and C in terms of rotation. 6 month, 12-month cycle will play out for each sector doing exceedingly well over time, and then passing on the relay, as we say, in a sports example, the relay race, the baton gets passed on to the next sector, because best part about economy is that a lot of these sectors are interlinked. When one sector does well, it attracts new set of players, new capacities are created. So competition comes in a little bit hurting the prospect. At the same time, when competition comes in, more jobs are created, new people get employed, and those people ends up getting consumer power, or they start consuming more of other products. So if for example there is more demand in IT as a business, IT companies employ more people. When they employ more people get employment. They end up buying a house or a car or a consumer durable or a vacation money they spend. I think those creates a virtuous cycle of one man's expense becoming other man's income, and by default, economy keeps on, let's say, growing. So over a longer period of time, I think all sectors will participate, whether it is banking, IT, capital goods, consumers, pharma. If I look at next 12 to 18 months time frame, which is what, let's say, the near term picture, I think in the immediate context, we are slightly better off looking at banking as a space where banks finally have a lot of things going right for them. Credit growth is back. Inflation gives them some sort of edge in terms of demand coming back. Rising interest rate makes them earn slightly more than what they would have ideally earned. And asset quality is perfect because Indian banks are coming from a 5-7 year problems of asset quality right now addressed. So banking looks good. We have post the correction, maybe something like IT looks interesting. Capital goods is a good theme in Indian context, where India is on this beautiful item called PLI. PLI is a sector by itself, having subsectors like chemical, pharma, auto, defense, etc., where each of these segment can attract money at times. And core theme in India is always going to be consumption. So if I look at next 12-18 months, I am reasonably confident that even consumption will find its way back in the in the investor portfolios as overweight, partly because when you're operating on a country with 140 odd crore population, you have to be positive on India being able to consume more, because especially when new jobs are being created, GDP is growing, per capita GDP is also growing. I think you have a nice case for consumption also to come back as a theme. So over a longer term, please do not worry about sectors is the one advice. At the same time, yeah, some preferences for near term is always on the cards.
Okay, well said. So probably banking and financials and IT probably, in the short term, as you said, yes, over a period of time, every sector will do good. I understand. And I think you partially answered this question. Is it good time to invest in bulk right now, or you'd rather prefer people to spread out over next 3 to 6 months?
No, I will prefer investors look at next 6 months as a time frame to invest rather than bulk. I think the bulk as a strategy should be used to buy during market panics rather than not. So when markets are on a upward trajectory, one should possibly remain in the SIP mode rather than using bulk. Again, it depends on the time frame. So if somebody tells me that actually my time frame is 10 years, then again I will not hesitate to say, yeah, please invest in bulk today itself, entire money, no need to do any SIPs. Because if your really investment time frame is long, then even that one day, even if you end up having bought on a relatively bad day in the sense that higher valuation, still it's okay for a longer term holding of 10 years. So I think it's the answer is slightly going to be linked to the time frame of the investor also.
Okay, got it. And generally, yeah, most of the retail investors who are coming in, they take for, they don't need the money for at least 5 years or 7 years or
Yes.
10 years. That's what the equity investors do. So they don't come for, hurry, in a hurry to make money. Generally, they are all well-informed investors. And your advice to retail investors, we are coming to close of the session. Another one or two questions. Your advice, anything specific that you would like to share with our subscribers, that do's and don'ts kind of thing.
So I think first advice is really that your investment process and investment temperament matters a lot. Process by default means your understanding of time frame and what sort of risk you want. So first advice is please respect your own time frames, your own risk appetite, and invest accordingly as per time frame. Which means, okay, when things do not go as per your plan, you are in a way mentally okay that this is not the problem, because I have anyway invested for 3 and 5 and 7 years. please do not hesitate, do not run around to evaluate your fund performance or your investment performance in like just 3 or 4 months when your time frame is longer. That is one advice. And so do not hesitate, do not rush in to say I want to make money in a short period of time. We all know that old saying, Rome was not built in a day, or a tree, takes its own sweet time to grow and then start delivering fruits. I think something similar is true for investments. Please take your time, invest wisely, and accept the outcome over a longer period of time rather than worrying about short term. So a particular advice really is that do not think 1 month and 3 month performance of a company or a fund as a problem or a reason to be very happy about. Yes, you may get it lucky at times, but let's accept that it is lucky. uh, a return expectation of if you investing when you invest in equity markets, let's say your starting point is really 12 to 15% kind of investment return expectations over a longer term in terms of CAGR. Respect that. There will be years where that 15 average will go to 18 or 20, and some year will be where the average goes to 10 and 12 depending on the year being good or bad in the markets. And do not get let's say worried with that. And last, but maybe not with the least, maybe the most important advice: stay invested as per your financial ability and capability. Capability I mean is, please do not use leverage. Invest your own money. Do not resort to taking loans to invest, or do not uh, invest on a leverage option, because that hurts very badly when things do go bad. Even if the time frame is longer, please do not use leverage. Is the another advice I can share.
Sure, all are great, things for a retail investor generally. And my last question, something personal about you. Do you have something to share with our subscribers which you like, don't like, hobby, family, anything? I leave it to you.
I think something is very similar to investment, and we get enough examples of this. Nature being the underlying solution. Look at nature in a way which is seasons. There is summer, winter, rains, and you realize how the outside environment changes. Something similar happens in markets. There are good times, there are bad times, and we have to run through everything. In rains, you do carry winter. In rains, you do carry, let's say, umbrellas around. And I think something very similar happens in markets, in life also. I'm not trying to relate market as the entire thing. I think that's one part of life. We learn a lot on a daily basis. Market teaches us a lot of assumptions underlying, change very fast. Yes, some of our rules also involve, acting on a variable which are known to us in terms of expectation, but we do not know the certainty of it. So, which also, for example, if you invested in some companies and suddenly there is a change in regulatory policy, or suddenly there is some change in some other country, you know, uh, where you are either an importer or exporter, and the rules change there. Yeah, companies do get suffer, and that's what your other example. Okay, some of these events do happen which are against your wish, but they are part and parcel of overall process where it may not be exactly as what you want. I think that's a big story, that yes, we have to be prepared for some eventualities which may not work. Yeah, we have to be ready with our plans. We have to be ready with our thought process. But at the same time, yes, not every outcome you will find fully happening, and that's where the ability to change your plans, change your thought process matters far more.
Good, good. Thank you, Krishna, for taking time out in your busy schedule and share your thoughts with our subscribers. I'm sure that this will help our subscribers as well as Mahindra Mutual Fund in a mutual way. Thanks for time once again. Thanks for taking time out. And next time, when you are in Chennai, let us meet up. Thank you
For
very much.
sure. That will be a pleasure to meet up in Chennai. And again, to all your investors, I think wish you happy investing, stay invested. I think India is on a wealth creation mode. As economy grows, corporate earnings will grow, and and the investors are likely to make this wealth creation journey pretty, I think, interesting in terms of ability to generate wealth over this next maybe 5-10 year cycle of economic growth. So happy investing, everyone.
Thank
Thanks a lot.
you. Thank you. Thank you.